If your pay goes up 1%, but prices rise about 3%, you feel squeezed. That's why $500 can seem small. But here's the thing, it's enough to start. I'll show you, step by step, how to use $500 to build a simple dividend plan with DRIP, Automatic Dividend Reinvestment. We'll keep it beginner-friendly. Clear rules to pick investments, a small starter portfolio, and realistic what it could look like numbers. I'll explain yield, your payout today, versus growth, your payout increasing over time, and why time matters more than starting size. There's one common mistake that ruins dividend plans, and a $2 per week habit that fixes it. But first, I'll explain why saving your money alone loses buying power. Then we'll fix it. You've seen it at the checkout line. If groceries were $150, with about 3% inflation, they become $154.50. The same thing happens with rent, utilities, gas, almost everything. Here's the simple truth. If your cash earns less than inflation, around 2.5 to 3%, your buying power shrinks. And if your raise is only 1 to 2%, you're still falling behind, even if your bank balance looks bigger. Most people think they need thousands to invest. They wait. But time, not a big starting amount, is the real lever. A phone loses value the day you buy it. $500 invested can pay you. Then those payments can buy more shares that pay you again. That's your snowball. You might be thinking, $500 won't matter, but waiting is what hurts. Saving alone only wins when your interest beats inflation and taxes, which, honestly, is rare. Every month you wait is one less month of compounding. Shift your mindset from, I need a lot to start, to, I need a system that grows on its own. One more thing beginners miss: chasing big yields. A double-digit yield might look exciting, but without growth it can be a trap. High yields often mean higher risk of cuts. A safer path for beginners is a moderate yield with steady raises over time. So what are dividends exactly? And how do you turn them into income later? Let's make that simple. A dividend is a cash payment a company sends to its owners, usually every 3 months. You don't sell anything to get it. If you own the stock on the right date, you get paid. You can reinvest that cash to grow faster now, or take it later as income. Here's the simple switch that makes this work. Turn on DRIP, Dividend Reinvestment Plan. DRIP means every dividend you receive automatically buys more shares for you, even tiny fractions of a share if your broker allows it. It's compounding on autopilot. Buy, earn, reinvest, repeat. Each new share earns its own dividend, which buys more shares. That's your snowball. Quick example. Put $500 into a stock or ETF with a 5% dividend yield. In year 1, you get about $25 in dividends. With DRIP on, that $25 buys more shares right away. Next year, you earn 5% on $525 instead of $500. Then those dividends buy more shares, and so on. It starts slow, but your share count and your payouts grow over time. The key idea? Your growing share count is the engine. Protect it, feed it, and let time do the heavy lifting. A common beginner mistake is chasing double-digit yields. A 10 to 12% yield is often a warning sign that trouble may be coming, like a future dividend cut. If a dividend is cut, your income drops, the stock price can fall, and compounding stalls. For beginners, a safer range is usually a 2 to 5% yield with steady dividend increases. Dividend growth versus high yield? If you remember one thing, keep this. A moderate yield with rising payouts often beats a high yield that never grows. Why? Your income grows every year, and quality companies can rise in price too. You build income and net worth at the same time. Let's keep picking investments simple. Your rules, your filter, matter more than any single stock pick. A good filter protects you from big mistakes and keeps you moving forward. Start with the yield range. Aim for about 2 to 5%. Under 2% can be fine for fast-growing companies, but it won't feel like income. Over 5 to 6% often signals risk. Profits may not cover the dividend, or the business is facing trouble. If a company could safely pay 10 to 12% forever, its price wouldn't be that low. High yield usually means high risk. Next, look for dividend growth. Has the company raised its dividend for several years in a row? Slow and steady wins. Think 5 to 10% raises regularly. Over time, a 3 to 4% yield with 7 to 10% growth can beat a 7 to 8% yield that never grows. Don't just stare at today's percentage. Watch the trend. You also want price growth potential. Dividends pay you now, but rising stock prices grow your net worth. You're aiming for two engines: income you reinvest and a business that gets more valuable. You want rising cash flows and a rising business.
Business durability matters. Boring is good. Ask, will people still need this in 10 to 20 years? Consumer staples, utilities, healthcare, and broad finance tend to hold up better in tough times. Remember, healthy dividends come from healthy businesses. If the business weakens, the dividend can disappear. Run a quick resilience check. During past recessions, did the company keep or raise its dividend? Did it cut? A cut breaks trust. One cut isn't the end of the world, but beginners should usually skip it. Use diversification to lower risk. A low-cost dividend ETF gives instant diversification and a built-in screen for quality. Add a few strong individual names to learn without betting everything on one company. Watch costs and taxes. Fees add up. Every 0.1% you avoid compounds in your favor. In tax-advantaged accounts, dividends reinvest without yearly tax drag. In taxable accounts, check whether dividends are qualified and what your tax bracket is. Set guardrails. Don't load up on one sector just because it looks cheap. Spread across sectors and consider a small international slice. Rebalance once a year. Trim what ran hot, add to what lagged, and keep your target mix intact. Handle high-interest debt first. A 20% APR card beats any investment return. Pay it down. Keep your $2 weekly habit to maintain consistency, then increase contributions after the debt is gone. Use the simplicity rule. If you can't explain in 2 sentences why the company can pay and grow its dividend, skip it. Shortcut. Start with one core dividend ETF as your anchor. Add 2 to 4 powerful dividend growers. Keep it simple. Diversify. Turn on DRIP, and you're already ahead of most people. Now, let's see how that looks in a beginner-friendly mix. We're going to build a simple starter portfolio you can explain to a friend in under a minute. The anchor is a broad dividend equity ETF. Why? It gives you diversification, a rules-based screen for quality, and low costs. That's your base. Then, we'll add 3 or 4 established dividend growers from durable industries. Think consumer staples, healthcare, utilities, and a financial you can actually understand. Equal weight it to start. Later, as you learn, you can tweak the weights. Let's break it down. Your core anchor, the dividend ETF, might be 40 to 60% of the portfolio. It spreads your risk across dozens or hundreds of companies and bakes in a discipline you can lean on as a beginner. This is the piece that keeps you in the game when a single company stumbles. Now, add your dividend growers. Aim for moderate yield with strong dividend growth potential. For example, a consumer staple that's raised dividends for years, a healthcare name with consistent cash flows, a utility with regulated revenue and steady payouts, and a financial with a clear business model and a history of returning capital to shareholders. Equal weight them at, say, 10 to 15% each. If you're doing 4 names and a 50% ETF anchor, that's 12.5% each. Easy math, easy management. Next, estimate your portfolio metrics. Start with yield. Take each holding's yield times its weight, add them up. That gives you a blended yield, your starting income rate. Do the same with dividend growth expectations, using conservative ranges based on recent history and payout ratios. Financial, think about expected appreciation. You're not forecasting the market. You're setting realistic ranges so your brain doesn't make up stories during volatility. Now, realistic expectations. These are ranges, not guarantees. Markets move, businesses adapt. Sometimes they stumble. Your job isn't to predict the next 12 months. Your job is to run a process that works over decades. That means DRIP on everything, so dividends buy more shares automatically, and tiny deposits flowing in every week or month. The weekly habit is the quiet multiplier. Let's make it concrete. Allocate your $500 today. Half into the ETF, the rest split equally among 3 or 4 dividend growers. Turn on DRIP for each holding. Then, set a recurring micro deposit from your paycheck. $2 a week to start. If that feels laughably small, good. It should feel easy. The point is consistency. Common mistakes to avoid. Going all in on one juicy yield. Ignoring expense ratios, having no tax plan, and never rebalancing. Also, don't chase hot sectors because they did well last year. That's how you end up concentrating risk without realizing it. Okay, numbers time is coming. How far can $500 go with DRIP? And what happens when you add $2 a week? The difference will surprise you. Now, let's translate all of this into outcomes you can feel. We'll keep the assumptions moderate so your brain doesn't get seduced by lottery numbers. Think a blended portfolio yield around 3 to 4%, dividend growth in the mid to high single digits, and long-term price appreciation in that same ballpark. Nothing flashy, just quality, reinvested over time. Scenario 1. One-time $500 with DRIP on. Year 1 is humble. You might see around $15 to $20 in dividends and a small uptick in value if the market cooperates. It's not rent money, it's a proof of concept. But here's where most people mess up. They judge the strategy by year 1. Don't. By year 10, with every dividend buying fractions of more shares, you'll notice the snowball. Your balance can be a few $1,000s, and your annual dividends might cover a couple utility bills a year. It's not life-changing yet, but it's visible. Fast forward to year 20. DRIP has been quietly compounding the share count, and those shares are paying bigger dividends because the payouts rose over time. Now you're talking meaningful cash flow, hundreds, even over $1,000 a year, without you adding more money. That's the game revealing itself. By year 30, the compounding becomes loud. A few $100s turns into 5- and 6-figure balances surprisingly often when paired with rising dividends and reasonable price growth. The passive income at that point can feel like a part-time paycheck. Scenario 2. The exact same portfolio, but you add $2 a week. That's $8 to $10 a month. Ramen money. Here's the kicker. Those tiny contributions massively expand the outcome because you're combining time with consistency. Year 1 still looks small, but you've bought a little more share count, so your dividends buy a little more too. It's a double nudge. New contributions plus reinvested dividends. By year 10, the gap widens. Instead of a few thousand, you might be double that, and the annual dividend income starts to feel like a real line item, not a rounding error. The reason this works is simple. Every tiny deposit speeds up how quickly DRIP can buy more shares, which then spin off larger dividends, which buy even more shares. It's a feedback loop. By year 20, the results separate meaningfully. The one-time $500 is respectable, but $500 plus $2 a week is miles ahead, often multiples higher, and the dividend checks reflect it. And by year 30, this is where the aha sinks in. The habit matters more than the perfect stock pick. $2 a week, scaling to 5 or 10 as your income rises, can turn a modest start into real income. Now, reality check. Dividends aren't guaranteed. Companies raise, pause, or cut. Prices swing. The way you beat that is with diversification, a quality tilt, and a process you stick to. Keep investing through downturns. DRIP buys more when prices are lower, which sets you up for stronger rebounds. Manage sequence risk with an emergency fund so you don't sell at the worst time. Rebalance yearly to keep your mix aligned. The secret setup that quietly doubles your compounding speed? Automation. Automate contributions, automate DRIP, automate rebalancing reminders. Remove willpower from the system so the system runs when life gets messy. Now, let's lock that in. Open a low-cost brokerage, or if you're eligible, an IRA. Compare trading fees, DRIP availability, and fractional share support. This matters because friction kills consistency. Fund your account with the $500 and place your starter orders according to your mix. Keep it simple. Core dividend ETF as your anchor, plus 2 to 4 durable dividend growers. As soon as positions settle,
Enable drip on every holding. Next, set a recurring transfer for $2 a week. Easiest path? Split your paycheck so a tiny slice lands in the brokerage automatically. If your bank supports scheduled transfers, use that. The rule is simple. Never turn off drip. Never skip a deposit. Put that sentence in your Notes app. Tape it to your monitor. Whatever works.
Schedule a 30-minute annual review. What do you check? Dividend safety signals, like payout ratio trends, cash flow coverage, and whether the company maintained or grew its dividend. Look at sector weights. Did one area balloon? Trim back to your targets. Check expense ratios on any funds you hold. If a cheaper alternative with similar exposure exists, consider it. Keep taxable consequences in mind when you swap. Tax placement matters. If you've got an IRA or Roth IRA, dividend strategies often fit well there because the reinvestment doesn't get taxed each year. In taxable accounts, confirm whether your dividends are qualified and where your bracket sits. Lower ongoing tax drag means more reinvested. Debt priorities come next. If you're carrying high-interest balances, anything near 20% APR, divert extra cash to crush that first. It's a guaranteed return that beats any realistic market projection. Keep contributing your $2 to preserve the habit, then scale deposits once the debt is handled. Build an education habit. One short article or a single book chapter per week on dividend growth, payout ratios, and diversification. You don't need to be an analyst, but you do need to recognize red flags and avoid concentration risk. The thing most people miss is that a little weekly learning compounds just like capital. As your income grows, automatically raise deposits. A simple ladder, $2 to $5 to $10 a week, timed with raises or bonuses. If it's automatic, you won't miss it. And if markets fall? Good. DRIP and deposits buy more shares at better yields. That's where long-term returns often come from. Common pitfalls to avoid. Chasing hot 10% yields, panic selling during downturns, ignoring fees and taxes, and letting one sector dominate. Keep your filter tight, your costs low, and your deposits boringly consistent. Now you try. Open the account, fund $500, place the orders, turn on DRIP, set the $2 weekly transfer, and put your 12-month review on the calendar. Small, automatic, relentless. That's how you get ahead of the pack. If you remember nothing else, remember this. Compounding runs on two fuels, time and consistency. Your $500 is enough if you turn on DRIP and keep adding a little, even $2 a week. The average path drifts. Your system decides your destination. If you're serious about getting your finances on track, and maybe even getting ahead of the pack, subscribe. Then watch the next video on why wealth building gets easier after $100,000. The choice is yours. Set up DRIP today, schedule that $2 this week, and don't stop.